Hello, 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 and welcome. I'm your host, Latanya Martin, and this is Buying and Selling Nashville. Today, I have with us Joe Spicer, who is the owner and broker of Knowledge Tree Mortgage here in Nashville. And he's been owner broker of that mortgage company for 17 years. I am Latanya Martin. I'm the broker owner of Grand Style Homes, and I've been in the real estate industry for 18 years. Today, we're talking about a great subject. We're talking about how does equity benefit the community? First of all, let's answer the question. What is homeowners equity? What is equity? Equity is the difference in what you owe on your home versus what your home is worth, right? There's a gap. Most people, especially now, you've owned your home for 3 years or less, have equity in your home. What can you do with that equity? What's the purpose of that equity? What can you do with it? How can it help you? How can it benefit you? And how does it benefit the community? So, the first question that we're going to ask Mr. Spicer today is how can a homeowner utilize the equity in their home?
That's a good question. That's really there's really only one way to utilize that equity. Well, actually, two ways. Actually, you either have to refinance your home or you have to sell the house in order to capitalize on the equity that's inside that property. Absolutely. So those are the only two mechanisms that somebody could use to be able to, utilize equity in their home.
Okay. And the question is, why would I want to do that? So, if I want to stay in my home, how would the equity help me? I got some debt I want to get rid of. Will it help me with that? What will utilizing the equity if I decide to stay here, especially during COVID? You do have some buyers that want to maintain and stay in their home and fix it up and renovate it. How can equity help me there? Or if I move, um, I don't really have any money saved. So I
Hmm.
really can't buy anything unless I do sell and use those funds. But there's some funds that I may need prior to closing upfront, such as my earnest money and some upfront fees that I have to pay. How can I utilize my equity that way as well?
Good question. So, just to, you know, this is one of the, verbiage that is used in the housing business, how important home ownership is within the community, correct? But I think a lot of times the value is not really, um, for the lack of a better word, it's not really broken down to us the true value of home ownership, and it's that equity that's in the home that makes it the most valuable asset or investment that we can do. But in some communities, we are not educated about what equity is and how it can really benefit us in the long term, right? And so in some communities, we buy a home with the sole intention, purpose of making that what we call our home and getting it paid off, right? And there's nothing wrong with getting the home paid off at all. But like I tell a lot of people is that if you don't utilize the equity in your home, you for 30 years, you're no different than a renter. The negative part to that is that you're going to be responsible for the upkeep, the maintenance on that property. So for 30 years, if you never learn what equity is and how it can benefit you, then 30 years of your existing, you're no home ownership existing. You're no different than a person who rents. Okay, because the equity is the only thing that separates the two. Because people say, well, argument would be, well, you're not right because I own this house. True, you own it when you pay it off or after the 30 years elapsed and you paid the house off. But until then, you're making a payment, and we classify it as a mortgage payment to your lender, right? Versus you making it, that's, somebody who pays rent, they're paying it to a landlord. They're both the same. They just have different terminology to it. So it's very important that we learn what equity is and how it can benefit us. And that is, I think, is the number one key element to whether or not you feel poor or think you poor or what have you. I always say, LaTanya, that I never understood, if you're a homeowner, you can't be poor.
And I want to talk about that. So so for those who own a home and you're ready to sell, great, love to help you. Again, most people, if you've been in your home for 3 years, you have equity in your home. The amount of equity is the question, right?
Correct.
What do you owe on that home versus what we can sell that home for? That difference is your equity. Correct. So if you decide to sell, that money is what you'll get at closing, and you can also utilize that to purchase another property, right? Correct. To purchase your next home. That's correct. One way. But correct. For those who, are living in your home and don't want to move, want to stay there, want to do some renovations, want to add a deck, want to add a pool, want to pay off some bills, want to get some debt down, may want to get married and have a wedding and use some funds, who need money for other things, and you have that money sitting there, you're not looking to buy anything, there's some choices, there's some things you can do with those funds. Or you may have someone who wants to buy an investment property. That's money there sitting that you can utilize. So let's talk about what's there and how you can utilize, how you can grab those funds now while you're still in that home. So there are a couple of options, loan options, that I want Joe to discuss with us. And the two that I'm familiar with are a home equity loan, and then there's also a equity line of credit. Is that right? So I want you to talk about refinancing your home. You can refinance, cash out. Joe, talk a little bit about that. The options for the homeowner who wants to remain in that home, but utilize some of those funds to do other things within that home or whatever else they need to use those funds for.
Right. And so all of those things you just named, home equity loan, lines of credit, or whatever you call it, it still goes underneath the umbrella of refinancing, right? And either you're going to have a second lien on your home or you're going to have a first lien. But in either case, refinance, let's break down the terminology in a simplistic way of what refinancing is, right? Refinancing is basically you are renegotiating or redoing the paperwork that is on your current mortgage, is basically what a refinance is. And so it's a refinance is basically, again, it's just verbiage that is renegotiated. So, and that's all refinancing is. But refinancing falls underneath that same category of a home equity loan that you go to the bank and get. And all the difference between refinancing your home to rechange the terms, the interest rate, versus the home equity line of credit. A home equity line of credit on your home is basically like you having a large credit card that you can utilize over and over and over again. That's all a home equity is a credit card that is attached to, and the collateral being used to give you that line of credit is your home, right? And it has an open feature to it. So that's why we call it a credit card, right? A large, very important credit card. Whereas on the other side of the spectrum, underneath the same umbrella of refinancing is you when you refinance your home and get the equity. Now you don't have that ability to, once you pay it off, then you can go back and borrow it again. No, it's a closed deal, meaning that they're going to give you the money in a lump sum. We're going to give you the $50,000 in a lump sum to utilize how you choose to utilize it, but your new payment is now comes into place. So where you were paying, say, $800, now you say, I want to go ahead and get this $50,000 of cash in my hand so I can utilize it the way I want to utilize it. Now, instead of that payment being $800, it may be $850 or whatever the case may be. And the terms of the loan may be changed. All of this is through your negotiation or what you want to see. So you could be you only had 15 years left to pay on your home and you want to keep it that way. So we keep you at a 15-year payment based on what you owe plus the $50,000 that you want to get. And that becomes your new payment on a 15-year term. You see what I'm saying? So a refinance, again, is just you renegotiating your terms of your payment and your interest rate. That's it. A line of credit is just an open credit card against your home.
Okay. And for someone thinking about, I want to refinance my home, because I know I have a client that's been in their home maybe just 2 years, and they're like, I already have equity, I want to refinance. Again, we talked about there's different reasons for you wanting to, but if you refinance also and say you're at a 30-year, you can refinance that into a 15-year, making your mortgage length shorter. Tell me about that, as well as rates. Rates right now, last year, especially at an all-time low, they're still low. How does refinance rates and purchase rates relate, or how are they different? Okay. What are they looking like, estimate, right now?
Yeah, another good question. So your interest rate, regardless if you're going to refinance your home or purchase it, it's the same. Okay. There is no different. The terminology is different because, if you're purchasing the home, that means you're buying it. That's the first, that's a home that you never lived in. That's why we call it a purchase, right? But if there's a home that you live in and you want to do a loan against it, it's called a refinance. So that's a different terminology there. And again, they're both, the interest rates are the same. I know people like to think that, well, when I bought my home, my interest rate was this because it was a purchase. Now, when I refinance my house, I should get a better rate because I'm just refinancing the home that I'm in. A person who's buying a home or a person who's refinancing, the rate is based on, a lot of times, your interest rate is based on what your credit score looks like. Okay. And so it doesn't matter if Mrs. Smith refinanced her house or she bought a home, the rate is going to be the same either way it goes based on her credit score. So interest rates are totally based on someone's credit score.
Okay.
And let me throw this in too. There's a little caveat to the refinance part that I must say. All right. And so your interest rate can vary based on what we call your LTV or your loan to value situation. So the higher that loan to value, that could create a hit to that interest rate as well. So that is a little difference there. And it's the same as a purchase. So the more money a person puts down on a home, which decrease the LTV of the property, then their interest rate is also taken into consideration against that loan to value.
Okay. Now, how easy is it to do a refinance? Because I know when I was looking into refinancing, if you have a certain type of mortgage, it's streamlined.
Correct.
There may be less paperwork. So tell us what that means and what that entails and what the different types of refinancing you can do, and how does that work?
Okay. Yeah. So a streamlined program underneath a refinance means that you're not going to access any equity. You're not getting any equity out of the home. Okay. It just simply means that you want to renegotiate the terms of your loan. So, for an example, in a streamlined situation, you cannot, if you was on a 30-year mortgage, you cannot renegotiate to a 15-year or a 10-year loan. That's not considered a streamlined program. You have to go back to the exact same terms that you had when you first done the mortgage. You can only, in a streamline, we're only renegotiating the interest rate. That's
Okay.
it. Okay.
But
So
that's
you,
paperwork or something, right? Is that what it is?
that's why
It's
it's
something.
less paperwork.
Okay. Okay.
Yeah, because all we're doing is saying, okay, Mrs. Smith, you when you bought this house, you was at a 4% interest rate or 5% or 6%. Now the rates is down in the threes or twos, and so you want to take advantage of the interest rate. So that's why we call it streamlining it. Okay, that's it. Versus a refinance, a full blown refinance where you have to give more paperwork, income documentations and stuff of that nature, is because you're trying to access some equity, which is going to renegotiate the loan amount that you owe on the house. So if somebody owes 100 and they're wanting to take $50,000 of their equity to do some things with it, now you're increasing what is owed on the home, which now becomes a full-blown refinance situation, which is going to require, employment information, income, and stuff of that nature.
Basically the same thing that you had to do when you first purchased, right? They're going to
Absolutely.
look at credit,
Absolutely.
they're going to look at everything, those same documents. Okay.
Yeah, and that's the thing, Latanya, is that I want your listeners to understand that the terminology that we use in the mortgage business and housing, I want to try to break it down to it, but it's more simplistic terminology, because I think it's that terminology that has so many people in the community afraid to access or understand how equity can truly benefit them.
Right. Okay. What was I going to ask you? So with going back to that streamline, there was only a particular type of loan that you could have to get that, right? You couldn't, I think it was FHA, and it has to be a particular type of loan that you had in order to even be able to qualify for that particular type of financing. Is that correct?
Yeah, well, some lending programs out there will allow you to do a streamline, FHA or otherwise. But FHA is the core type of loan. And let me just put a pencil there with FHA again, terminology, right? Do most of your clients understand what an FHA loan is, what a VA loan is, what a conventional loan is? Because again, terminology and what we do over at Knowles Tree Mortgage, and the reason why we've been in business for 17 years is we try to educate the client about about their mortgage in their home, right? And just to use simplistic words about FHA, VA, conventional, and all of those things. An FHA loan is just an insurance policy that the lender gets from Fannie Mae or Freddie Mac that says that if this particular borrower should go into a foreclosure situation, then you can use this insurance policy and we will give you your money back or part of it to the lender, to the financial institution, and then the Freddie Mae or Fannie Mae or Freddie Mac takes that home underneath what they label as a foreclosed, a HUD foreclosed home. And basically, again, all FHA, VA loans are insurance policies for the lender. That's all it is. A conventional loan does not have, is not associated with a Freddie Mac or Fannie Mae type of insurance structure. That's why on a conventional loan, they require you to put up 20% because that ensures the lender in the event you should go into foreclosure. So I just wanted your people to understand, again, the terminology and what's the difference in that, what that terminology really means, okay?
When you mentioned 20%, I do want to go back to that. So typically, when you get FHA, it used to be back in the day, once your loan or what you owe is down to 80% of what the value of your home is, you will refinance to get that mortgage insurance taken off. Correct. Now I think that's changed to where you can't take it off.
Correct.
But in the same token, as you brought up conventional, now if you do not put down that 20% on conventional, you do have to pay that mortgage insurance now on conventional.
That's correct.
So the question is, does that automatically come off, or do you have to refinance the conventional mortgage now to get that to come off?
So in the conventional, it's still the same way. Once you reach an 80% threshold of equity in that home, then you can get that MI insurance taken off of it. So again, we're talking about MI, PMI, and MI. PMI is the mortgage insurance. See, and I wonder how many people knew that they were paying for that insurance policy on their mortgage, right? And on the FHA loan and the VA, it's called PMI, right? And it's that premium. It's just like you paying a premium on your homeowner's insurance or your car insurance. You're paying a premium for Fannie Mae and Freddie Mac to guarantee that you are a qualifiable person for that mortgage loan that the lender is going to give you the money for. Without Fannie Mae and Freddie Mac being in existence, there would be no way a lot of people can become a homeowner without having that 20%. And that's where we can thank the federal government for, especially in the African American community, because it was that opened up the avenue for African Americans to be able to become homeowners in America. Because if you can remember, that was redlining in America. And so through the systems of the existence of Freddie Mac and Fannie Mae, that opened up the avenues for Black Americans to be able to become homeowners. Without it, you could not become a homeowner unless you saved 20% to put down on a home. So again, many people did not even realize that the PMI that so many people talk about trying to get around, if you don't have at least a 20% equity stake in the home, most lenders, they didn't care how well your credit was. They were not lending you money on that home. You see, so you have to pay mortgage insurance to some lender. Otherwise, you will never be able to become a homeowner unless you had 20%. So that's why they have PMI and MI on these loans. And the reason why FHA here lately removed that, where you can never get rid of that, is because of the 2008 2009 collapse of the home of the housing market. When that happened, everything went to what they call hell in the handbasket, and without, and so FHA, the Fannie Mae and Freddie Mac was losing so much money. They had lost so much money that the government had to come in and bail them out, remember? And so in order to keep that from happening in the future, they got to keep collecting that insurance money, right, to keep them afloat, right? And that's why they did away with, you can never no longer get rid of it, even once you reach the 20% threshold. You understand? So I don't know how many of your listeners knew that. I know that's not something that's talked about on a lot of podcasts and a lot of these social media sites. Again, when you are choosing a mortgage lender, you need to choose a mortgage lender that can educate you beyond what standards are, because that's why we don't understand it, in especially in the Black community. And I ask this question a lot of times, LaTanya. I say, why is it that you can identify a minority neighborhood in any city in the United States that you go to? Because we all go out of town, right? And I guarantee you can identify a minority neighborhood and not know why you can, right? The reason why you identify minority neighborhoods so much in any city that you go into is because they have never been educated about equity, right? They've never been educated about equity. They know nothing about it. They're frightened of it, because what's been taught in the African American community about home ownership is to get it paid off as soon as possible. And so even having, and I say this a lot of times, even having a paid for home doesn't exempt you from having financial problems, right? But the reason why I say you cannot be poor and own a home is because of the equity that's in the home. That's why you cannot be poor and own a home. But when you're constantly leaving your financial matters into hands of people who are not trying to educate you, then you have the assumption or the mindset that you're poor when you own a home. You understand what I'm saying? And that is what has crippled so many African Americans in this country.
Mm-hmm. We do have a question too. I'm sorry. Go ahead. I'm sorry. Go ahead.
No, go ahead.
Joe.
No, go ahead.
We have a question from Facebook on Jay Stewart. Is it hard to refinance a loan when the buyer has used a down payment assistance program such as USDA, THDA, or housing fund program?
Absolutely. Good question, because again, and I joke a lot about, African Americans, we are keen on programs, right? But some of those programs, such as what just got named, does limit you to having the ability to access equity, because they got what they call a recapture clause in those programs, right? And some of those programs have a 10-year recapture clause, meaning that if you go and refinance your house underneath those programs, you're going to have to pay back the down payment assistance or whatever they helped you with, right? And sometimes that's okay. I had one of those programs when I first bought my first home. I had a THDA loan, right? But I went ahead on a refinance because it was in my benefit to do so. Well, let me take that back. I didn't know. So I ran the 10-year course before I refinanced my house. And had I known what I know today, I would have rethought that program. Let me just say it like that. Okay. But yes, having those programs does limit you on any access to that equity, which kills a lot of people. The other programs out there that a lot of elderly use is programs where the city or state or whatever comes in and give seniors, they come in and they fix their homes up, give them new windows, put a new roof, insulate their homes underneath this weather program, right? But you can't refinance that house and capitalize on any equity. Otherwise, you're going to have to pay back that money that they gave to you. And again, because we don't know about equity, we've never been taught about it, the value of it. That's why we seek out programs, right? That's why we asked about programs. And sometimes those programs can be a detriment. I'm not saying they're not good. I myself had one. And I encourage anybody, if that's the only thing you have to do to become a homeowner, take that program, right? Because it does give you the ability to get into a home. So I'm not saying programs are bad by no means. I'm just saying to evaluate before you take the programs and know what you're getting yourself into.
Correct. And now Joe is also an investor, right? So he owns rental property, fix and flips, construction, renovations, all that type of thing. So what I find also is you have some buyers that only want to buy because they want to become a homeowner, but you have some buyers that buy because they want to be an investor. So they want to buy an investment property. And you have some that, may get a duplex and live on one side, or a triplex and live in one. But then you have those who've owned a home for a while too. And because this is about, again, equity and that type of thing. You have some homeowners who've lived in their property and want to become an investor. So how could they utilize that equity that they have in their home to maybe purchase a property? What type of, what would be a good way for them to utilize that equity for that purpose, and how would they go about doing that? What's a quick tip on that?
Let me just first I'm going to use myself, because this is this is where I came from. Okay. I came from the projects in East Nashville. Okay. And, I didn't have what they call a pot to piss in, so to speak, coming from the projects. Right. And I didn't know about banking, savings, because I lived on government programs, right? And so when I finally, got to a stage in life where I bought my first home, it was the equity that bought me my first investment property. I refinanced my house, and I used the refinancing cash, and I paid off my debt because, again, back then, the motto was to become debt free, right? Down to just your mortgage. And so that's what I done. But I kept a little money aside, and I bought my first piece of investment property. But back then, that's when they was doing 100% financing, right? Those days are long gone. But I used the equity in my home to buy my first piece of rental property. And when I bought that piece of rental property and sold it and capitalized on the cash, and again, you got to remember, I came from the project. It was hard for me to save $1,000, LaTanya, right? When I sold my first piece of property, and I'm telling you, when I put that $15,000 in my account, I mean, you could have, oh man, I thought I was Rockefeller. I was just like, what? I was just on cloud nine at that point, right? Because it was more money than I could ever save, that, just going out there working on my job, right? And so that would catapult me into investment in real estate. And again, it was through equity that allowed me to open up my businesses, right? So there's a lot of people who have an entrepreneur spirit, but they can't get bank loans. And let me just share with your listeners, I was 15 years in banking. I worked for Regions Bank, as you know it now, Regions Bank, branch manager over at Regions Bank over on Gallatin Road. And so I remember people coming in who had those entrepreneur spirit, but there were certain categories of business that the bank just doesn't loan on. Restaurants are one of them because it's a high risk business. And what I try to tell a lot of people that had that entrepreneur spirit who wanted to become open up their own restaurant, I told them about equity, using the equity in their home to open up that business. The same way I done. I use equity in real estate to start up my insurance company and to start up my mortgage company. So equity has a valuable asset to it. It can change so many people's life in a positive way. We just have to be more educated about equity, and we have to go to places that are going to try to educate us about equity. Stop going to these places that are not trying to help you benefit through your home, right? Because when you go to these places, they go, a home equity line of credit, it's just a big credit card, right? And unless you paying more on it every month, the balance is never going to change because it's like a credit card. And that's why I tell people, let me listen to you first before I give you which option you should be taking, because everything don't work for everybody. It's not a cookie cutter situation. Your financial picture is individualized, and it's not a cookie cutter situation.
I agree. And just like you, education is very key and important. And it's one thing that we always do when we meet with clients. We make sure we do a consultation. We tell them what their options are. We try to make sure we have other a lender, insurance agent, other people on the line too, if possible. Otherwise, we connect them to the people that we know that will also make sure that they make the right decisions or help them make the right decisions, because not everybody is ready, but you do need to see if you are, right? Yeah. Asking those questions is important, as well as you don't know what you don't know. So if you ask, that's great, but you also want someone who's going to just provide you with information that's going to be very informative and help you make some decisions that you're going to be making.
Yeah. A lot of times you don't know what to ask because you never experienced it. When I came out of projects, I wouldn't have known to ask about equity because I never owned a house.
Right. And it goes back to what you said. Goes back to what you said. Make sure you have a good lender, but make sure you have a good realtor. Make sure you got somebody telling you and helping you understand and break down the things and the process, because that's going to be very important for you. I'm sorry, Joe. I appreciate you coming on. We're over our 30 minutes. We can keep going on and on because you have a wealth of information, and there's a lot of information that we can share. But I hope this was beneficial to everyone that was listening. Inbox or DM Joe or I if you have additional questions. We appreciate you listening. Are there any closing words or remarks, Joe, that you want to give?
I just want to let everybody know you can call us up at Knowledge Tree Mortgage. Our number over there is 615-859-9599, or you can go to our website, knowledgetree.blending.com, or shoot us an email at knowledgetree@K, the letter K, the word tree, TREEMTG.com, and we will respond to you if you shoot us an email or call us up, 615-859-9599.
Absolutely. And again, inbox me if you're watching this, or you can reach me at grandstylehomes.com or latanyamartin.com. Thanks again, Joe, and we look forward to doing business with you and talking to you again soon, and have you on again as well.
All right. Thanks a lot, Latanya. Have a good day.